Good morning. Welcome on our webinar on employee benefits, where we will further explain to you everything regarding employee benefits in accordance with IFRS. Speakers of today, Sam Verfaillie, partner at Finvision, and myself, Hans Everecht, a manager at Finvision, both working in the IFRS and consolidation department. Some practical logistics which are similar as our previous webinars. So for everybody who's joining again, this is nothing new. So everybody's in mute only mode. We will talk for a maximum 1.5 hours. If you have any questions, please address them to us in the chat and address them both to the panelists and the hosts. We will have a short poll to evaluate our webinar at the end, and every recording will be made available on our website subsequently. Principle, you can find the handouts already in the webinar module, so you can find the slides there as well as some additional information we will go through this webinar. We already had the first webinar earlier this year on intangible assets. Today's topic is employee benefits, and later this year we will be talking about leases as well as the ESMA and IFRS updates in December. Scope and table of content for today. First, we will talk about what is the scope of IAS 19 and employee benefits. Then we will further go into short-term employee benefits, post-employee benefits, and termination benefits. And then also some further details and a practical example on how to calculate defined benefit obligation using the PUC method. What are actuarial assumptions and how to deal with them? What is the impact of changing assumptions? And finally, we will give an example on what disclosure requirements IAS 19 has when applying this standard. First, the objective. IAS 19 has been set to prescribe principles of accounting treatment for employee benefits. What is now an employee benefits? Basically, any consideration you give in exchange for services by an employee, or, and that is on top of rendering services, for the termination of the employment. So standards provides the recognition of a liability if this is given in exchange for the services or benefits to be paid in the future. And the idea is to recognize the expense when the services are provided, so we have an economic representation. What employee benefits are in scope? Anything arising from formal plans or contracts, anything arising from legal requirements, and also informal practices resulting in a constructive obligation. What is out of scope of IAS 19? That is specifically share-based payments. There is this separate standard for that, dealing with that and explaining how to account for share-based payments, which are also given in exchange for services being rendered. There is a separate standard as well for pension funds itself, that's IAS 26, which is not in scope here. So the idea of IAS 19 is to explain for employers how to account for their pension liabilities. If those pension assets and liabilities have been externalized in a separate legal entity pension fund, then there is a separate accounting standard dealing and explaining how to account within those pension funds. First of all, short-term employee benefits. That is basically everything that is expected to be fully settled within 12 months after the end of the period where the employees rendered their related services. So in practice, it relates to the salaries payable, wages payable, social contributions, paid annual leave, profit and sharing, and bonuses. We'll come back on specific matters there later, and also non-monetary benefits such as medical care. So it's quite broad scope, which is usually presented in the payroll liabilities on short-term liabilities. How to recognize there? The undiscounted amount of short-term employee benefits expected to be payable should be recognized. Important there, it's expected to be payable. So even though it's short-term, there might be a possibility that some become not payable. We'll go deeper in that, for example, when we talk about bonuses. What is not recognized? What is the counterpost of liability that is in principle an expense, unless obviously it would be incorporated in a cost to build an asset, then it's capitalized as an asset and not included in the income statement as expense. What about short-term paid absences? I think most common is the accumulating. When the service is performed, accrued vacation balance is built up, then an expense is considered and a liability is paid up. If those short-term paid absences would not be accumulating, no entitlement to carry forward, then the cost is recognized when the absence occurs. What about profit sharing and bonus plans? There it's important, and it refers back to the general principle of IFRS. You need to have a present legal or constructive obligation to make such payments, and you need to be able to make a reliable estimate of the obligation. So combination of both is important, and in some instances, if one of both conditions cannot be met, it will not be possible to recognize the liability. What about loan bonus or non-recurrent advantages? So different bonuses. Same questions arise. Can you make a reliable estimate? And also important in the calculation of the liability, should you consider a possibility that some employees may leave and accordingly may not be entitled anymore to obtain the bonus? So calculation models should include that, and obviously depending on what terms and conditions have been set or the term that it results, the uncertainties might have a longer or higher impact. What about, so that's a specific example where employees would be entitled to sharing payments of 3% of profit. However, given start turnover, estimate would be that it would only result in a net 2.5%. So at that moment, you will only be able to recognize a liability and expense of 2.5% and not of 3%. So important there, or formal terms should be available, or the amounts are paid before the financial statements are authorized for issue, or your past practice clearly gives evidence that the company will anyhow pay it and has as such created a constructive obligation. It is important there, the consequence, that it will result in expense and not a distribution of profit. So the common practice in Belgium recently where you give a winstpremie, profit premium, under Belgian GAAP, that would result in profit allocation and a distribution just as a dividend. Under IFRS, this will have to be reclassified and be considered as an expense, a payroll expense under IFRS, given as it is given in return for rendering services by that person. Okay, so moving on to long-term and post-employment benefits. So post-employment benefits are benefits that become payable after the completion of employment. Also there are different examples possible. The most commonly known are the pensions and other retirement benefits. Less known but quite common is post-employment life insurance, or also post-employment medical care offered to employees which would become past employees at that moment. What is then a definition? Important there. First is the defined contribution plan. I think most commonly known is basically the entity will pay fixed contributions towards a separate entity, being a pension fund or being a qualified insurance entity. And important there, the entity will no longer have any legal or constructive obligation to pay further contribution apart from the fixed contribution they have been paying. What would be there? Examples is TAC 21 or TAC 23 investments that are not in scope of the law in Belgium guaranteeing a minimum guaranteed return. But we'll come back on that later on. So accounting treatment in a far and simple explanation. So you simply account for the cost equal to the contributions due for that period. There will in principle be no amounts recognized in the balance sheet unless some really short-term cutoff moment where you are becoming liable to pay that month's contribution, but it's only paid the month after. So besides that, we would expect no presentations in the balance sheet. And as such, IAS 19 does not foresee many disclosures for such defined contribution plans. What is then a defined benefit plan accounting treatment? And I will first go, what is a defined contribution plan? Sorry, those slides apparently mixed up. A defined benefit plan is basically everything which is not a defined contribution plan. So if you do not meet the definition of a defined contribution plan, as I just explained, you will fall in the scope of a defined benefit plan. And there, the commitment of the employer goes further than simply paying fixed contributions on a monthly, quarterly, or yearly basis. As such, it might become that the employer has a liabilities. What are some examples? A specific benefit formula, linking it to additional contributions, for example, the last salary of the employee or an average of the last 5 years. Additional guarantees, being a contractual guarantee or as set by law, or informal practices that result in the fact that the company, for example, keeps up the benefits for inflation. Going quickly back, what is then the accounting treatment? For a defined benefit plan, it's important that you will need actuarial calculation using the projected unit credit method. You will recognize a liability. In some limited cases, it could also be a defined benefit asset. And there you will give a net presentation by the entity of what is the full defined benefit obligation that will become due to the beneficiary of the post-employment, and what are the plan assets that have already been accumulating up. Important there as well, and that is the key difference with what exists under Belgium practice, is IAS 19 will project forward both defined benefit obligation as well as the plan assets, applying actuarial assumptions and then discount back to the net present value as of today. We'll come back on that and also give a practical example there. So the net difference results in or a defined benefit liability or a defined benefit asset being recognized by the company. The cost is recognized in income statement for changes in liability, but everything of the changes that results from changes in your actuarial assumptions, which is unexpected changes, goes directly to OCI and is not recognized in the income statement. A defined benefit plan also results in much more extensive disclosures. For example, plan assets, the full amount being presented and the evolution, the type of assets, because for readers of the accounts, it's important to understand what is the risk behind the net liability or net asset accounted for in your own balance sheet. If there are large assets behind it and large obligation, obviously the risk is larger than if both the DBO and the plan assets are limited. A defined contribution plan, as said before, you recognize simply when the service is performed and contribution are due. If in limited circumstances, I've not seen it in practice, the liability is already due to be accounted for, but it becomes only payable after 12 months, you should account for the net present value, and then a discount will be recognized through financial expenses over time. But in practice, I have not seen that often. Specifically for Belgium then. In Belgium, in the past, there were more defined benefit plans. Most defined benefit plans have been closed. And now the most common practice is defined contribution plans. However, there is the law Aanvullende Pensioenen, LPC, and that foresees that there is a minimum return for any contributions made by either the employer or by the employee. Initially, that was set at 3.25% for the employer, and 3.75% for employee contributions. However, given financial returns in the market went down in 2010 and beyond 2008, it became much more and much more insurance companies indicated, look, we cannot guarantee anymore the minimum returns foreseen by the law, so they went down. And then it became clear that in practice, if there is a delta and the actual returns of the plan assets are lower than the minimum returns foreseen by law, it's the employer that becomes liable. So going back to the definition of a defined contribution plan, it resulted in the final conclusion that in that case, even though legally it's a defined contribution plan, under IFRS, it should be considered as a defined benefit plan, given potentially if actual market returns are lower, the employer could be asked to give additional contributions into the pension fund or towards the insurance company. What is the minimum return? As said in the past, it was 3.25 and 3.75. It is basically derived in Belgium from the 10 years OLO, and it's the 85% of the average over the last 24 months. Given discounts rates were quite low over the last years, they have become to the minimum of 1.75 the last recent years. But every year there is a calculation made at the 1st of June. And depending on that outcome, the minimum of 1.75, which is currently in place, could change. And it will become effective then as from 1st of January of the following year. Given the average, the increase is slowed down a bit, but also the decrease if the discount rate would change over time. If we can look at the curves in place for the moment, as of August 23, you will see that the green line, which is the minimum 1.75, as well as the 85% average of the 10 years OLO, were more or less at the same place. Given, as I said, that the calculation is done in June, it doesn't change anything for closing of 2023. However, given discount rates and the yellow line is presenting that we're still going up or are consistently low, the lower rates of the 24 months calculation period will go out and the higher rates come in. So it is expected that in 2024, the minimum guaranteed will go up again higher than 1.75. Defined benefit assets and defined benefit liability. As I explained before, it's the net difference between your full defined benefit obligation and also the plan assets. Plan assets potentially corrected for the asset ceiling, which I will explain later on. What can be plan assets? Assets can or be held by a long-term employee benefit fund or it can be qualifying insurance policies being TAC 21, TAC 23. I think in Belgium, practice of having your assets on the balance sheet itself is no longer allowed. In some other countries, it's still partially possible, but in Belgium, it will be usually in an OFP, a pension fund, or in a qualifying insurance policy. What asset can be recognized if your plan assets in the projected calculations are higher than your defined benefit obligation? There is a limit, or it is the present value, the present value of refunds from the plan. If you're in a pension fund in Belgium, it's not allowed to obtain refunds, but for example, in Netherlands, that is possible that there are refunds made by the pension funds towards the employers. Then the present value is the actual refund that takes place, or reductions in future contributions to the plans. So if your plan assets are higher and it results that your contributions asked by the pension fund or by the insurance company could go down in the future, then you could also recognize plan assets, but at net present value then of what you expect to be future reductions in your contributions. So that's the asset ceiling test foreseen by IAS 19. If we go to the fair value of the plan assets in respect to qualifying insurance policies, there are different points of view in Belgium, which can result in a different valuation of your mathematical reserves or your plan assets at the moment, so resulting in a higher or a lower plan assets, and accordingly the net defined benefit liability or net defined benefit assets. And it basically boils down to the interpretation of paragraph 115 and paragraph 113. Whereas paragraph 115 foresees that there is a match and that it will be exactly the benefits payable will become the same as the present value of the related obligations. There is a perfect match. So you will consider your discounted value of X estimated future cash flows as your plan assets. IAS 19 paragraph 113 is a bit more strict, and that says that you should adjust for the possible insurer's insolvency risk, resulting in a little bit lower fair value of your plan assets because you take into account the insolvency risk. There are different views between the actuaries and the auditors, so that's a practice currently in Belgium. My understanding is that mostly they will go for paragraph 113, but some accept also the higher fair value. What is now a service cost? Actually, there are two matters to consider. There is the current service cost, being the cost of benefits earned during that year. It's calculated similarly, and the past service is adjustments that take place based on your years of service done before. It excludes the effect of the interest because, as stated below, that will be considered as a net interest that results from an interest cost on your benefit obligations and an interest income on your plan assets. Employee contributions are deducted because obviously that goes into the fund as well based on payments done by the employees or withheld by the employer on the net wage of the employee and passed on directly to the pension fund or the insurance company. So for the discount rates, when it comes to the interest income on plan assets, it's important to consider that under IFRS, you will use your discount rate to calculate what interest income will I show net off with the interest cost of your defined benefit obligations. Whereas under US GAAP, you will use there the expected rate of return, which can deviate from the discount rate. What are then actuarial gains of losses? Those are unexpected changes resulting from changes in your financial assumptions. So we have different actuarial assumptions, and some will come back that later on in what kind of assumptions can we have in practice. One part are the financial assumptions, example, change in discount rate. You have demographic assumptions, the mortality tables, or experience, which could be what are the expected salary increases, what is the expected turnover of the staff. Those are the different kind of assumptions. Changes in those assumptions result in actuarial gains or losses, and we will see later on. The impact of that will be recognized directly in OCI and not through the income statement. Important there as well, under IFRS, it remains in OCI and it will not be recycled, whereas in US GAAP, you can have recycling into P&L. There are also other long-term employee benefits. So besides short-term employee benefits and post-employee benefits, there are the long-term employee benefits. Those are not expected to be settled within 12 months, where the person renders services, which could be long-term absences, sabbatical leave, jubilee premiums. If, for example, after 20 years or 25 years, you get 1 month's worth of pay, then it's called a jubilee premium. That also falls into the scope of IAS 19. Any long-term disability benefits or early retirement provisions, that's always in the scope of IAS 19. It's similar accounting, but a simplified method as the post-employment benefits, but any gains or losses go to P&L. There is no split between P&L and OCI. Termination benefits. What are termination benefits? Basically, benefits payable as a result of a decision of the enterprise to terminate the employee's employment, and also the employee's decision to accept such voluntary redundancy. Typically, those are benefits payable upon a restructuring. And it will become recognized at the moment that your employer cannot withdraw the offer, and also when the restructuring charge is recognized in accordance with IAS 36. So remember there, rules under IFRS are more strict than under Belgian GAAP. Belgian GAAP allows the decision of the board as a starting point, whereas under IFRS, it should have been communicated because then it's clear that the employer cannot longer withdraw its offer. And if it's a voluntary termination benefit, the employees of acceptance of the offer is the triggering point. I think that is similarly what I just explained, but a bit more in detail. Important here, if you look at the different points explained here, you always need to take into account the expectation. So it's a decision of the entity, but it might be that reality, not all employees in scope will become entitled, and then your calculation of your liability should take that into account. The plan should be sufficiently clear so the employee can determine what amount they will expect, and on the other side allows the employer to calculate the liability. Practical example here, a company decides for a plant closure where 100 employees will lose their job. All of the employees get 15,000 euros of payment payable in 3 months upon announcement. And then there is a higher payment, so 15,000 euros incremental for employees staying the last year because the plant still requires cleanup. So it's an incentive for some people to keep on board, so the company is able to close everything down properly. A is considered as a termination benefit. It's a decision of the employer to close and to terminate the jobs and to offer a benefit on top of that in return. There are no further services required, and there is no impact of a decision of an employee. They will get the payment anyhow. So there, clearly, once it's offered and there's no way to withdraw the offer, the liability should be accounted for at 1.5 million, being all 101 employees times 15,000 euros. It's payable within 3 months, so no discount should be considered. The second offer, the 15,000 euros incremental payment, so in total 30,000, there that is offered in return for exchange of providing services. So what is the impact there? The expense and accordingly the liability, because it becomes payable at the end of the 12 months. If it becomes payable month on month, it is simply an expense towards liability that is immediately cash out, is recognized over the period that services are exchanged. So here in practice, you will see a monthly expense of 1/12 of 15,000 euro, the incremental amount, because remember, the first 15,000 euros was already recognized in the liability for all 100 employees. So the additional 15,000 euros is divided by 12 months and then monthly recognized over the period that the employee that is becoming entitled is receiving the services. Here you can see practical differences depending on whether the amount only becomes payable if they actually stay for 12 months or if they get a pro rata. If they only become vested if the employee itself stays for the full 12 months, you need to consider in your liability calculation also what is the possibility that some of those employees that are in scope will leave earlier than 12 months and will no longer be entitled to obtaining such additional benefit.
Hans, I see a question. Shouldn't we discount for the 12 months if the employee only receive it later? That would be correct. If the B would receive also the first 15,000 after later than 12 months because they need to stay 12 months, in that case, you would discount for those people also the 15,000 euro.
Yeah, I think once it becomes payable beyond 12 months, you need to consider a discount effect. If it's within 12 months of the balance sheet date where you need to calculate your liability, then no discount effect should be considered, because then you fall under the short-term employee benefits and not the long-term.
And an additional question I see, what discount rate should you use?
I think you should consider a discount rate depending on the term where it comes payable. So depending on if it's 12 months or 24 months payable.
So you would use also, it's more a borrowing rate that you would use.
Indeed. I think here there's an overview, and that links a bit back to that question, because you have termination benefits, and depending on in what scope they follow, you will have a different kind of measurement. Termination benefits following and expected to be settled within 12 months are considered as short-term employee benefits, so no discounting. For termination benefits to be settled beyond 12 months, those are the simplified version as required for post-employment. So any impact goes to the income statement, and termination benefits that are enhancement to post-employment benefits should be taken along with the calculations of the defined benefit or contribution plans.
So the latter you mean, for example, as part of the termination benefit, they do a contribution in the pension fund.
Yes, indeed. That's one of the examples could be. So if you get an enhancement on your pension payments, the change in the formula, or an additional one-off contribution, then it should be considered in the calculation of your defined benefit. So we move to defined benefit obligations, and I think Sam, that's where you take over.
Okay, so thank you, Hans. Hans, you went quite quickly, I think, through the post-employment benefits and the defined benefit. And the purpose now of the remaining part of this webinar, we will discuss a bit more in detail what is a DBO, what are the actual assumptions, what are changes, and how do you calculate it. So we will show a very simplified example, but realistic example, how a defined benefit obligation is being calculated. And then finally, we will look to an example of disclosures, and because the disclosures for IAS 19 defined benefit plans are quite extensive, so we will go through an example and walk through all the disclosure requirements. So typically for a defined benefit, we will use an actuary. It's very, unless you are also an actuary, and I know one company who did it because the person was also an actuary, but in most cases you will use a firm like Aon, Mercer, Towers and Watson, etc. Those are actuaries who are very familiar with calculating the defined benefit obligation. Sometimes also the insurer is doing it. But be careful also if the insurer is doing the calculation that they have sufficient knowledge and that they can also deliver to you the disclosures, which is not always the case. So defined benefit obligation, it's calculated by the actuary with a mathematical calculation, an actuarial calculation with actuarial techniques, and they will make some assumptions, financial assumptions, demographic assumptions, etc. We will come back on that in the next slides. And of course, they will follow the IAS 19 requirements, which can also, like Hans already explained, which can be different than under US GAAP, for example. IAS 19 clearly describes how you need to calculate the defined benefit obligation. Sometimes you see also, like Hans already explained, also different views by actuaries, how they will interpret certain requirements. But I will come back with also a point on that I have seen recently. It was, I think, Mercer who did this way of working. So the defined benefit obligation, of course, will depend on the assumptions you use. For example, the discount rate, but will depend on the benefits. I think if you look to the Belgian plan and with the minimum guarantee, I think this is a quite a simple one, but you can have more complex benefits like with several levels and so a complicated formula when and the amount that you'll receive at the end of at the beginning of your retirement. You will also estimate when the person or may be leaving, what is the probability of leaving. You will make assumptions about salary projections. So what will the salary be at the time of retirement? You will consider how long is a person expected to live. So what are the mortality tables? As the mortality tables that are will be used. So it's quite there's quite some assumptions added where actuaries are very familiar with. So if you look to the actuarial assumptions that you will see, the most common ones you will see, it always depends on the plan, and the plan will determine which assumptions are needed and which are more relevant and less relevant. But the financial assumption, a very important one, is, I think in Belgium there are two actually. It's the future salary increases. So certainly if it's a benefit based on salary, which is also the case for the Belgian plan, you will consider also future salary increases. Although you're not entitled on I think I will correct myself, for the Belgian plan, salary increases is maybe less relevant because the benefit does not depend necessarily on your last salary, but it will accumulate over the years, of course. But I will you will see that later on. But what is important is also
in practice, what most actuaries demand is, what is your future salary increase expected on top of the inflation? That's most commonly asked now by the actuaries.
Yeah, that's true. Yeah, because salary increase is also based on inflation, certainly in Belgium with the indexation. So you will always see that salary increases will be either equal or higher than inflation. Inflation not necessarily as being used. They will use this as an assumption, depending how they qualify the salary increases, but it will not necessarily, as a separate assumption, may not necessarily impact the calculations. In my example that I will show, it will impact also the calculation. And then a very important one, which has a significant impact, is the discount rate. I will come back on that, how we need to determine this assumption. And then we have the demographic assumptions, and this is about mortality. So when do we expect a man or a woman, unfortunately, to die? There are some clear statistics about, and that's being used. It's the MMR and the MF tables. What is the assumption when how much turnover will be? Like Hans explained also, for example, in the long-term benefits, you need to estimate also what is the probability that a person will stay until the time of payment, until the retirement age of the company. And so that's something you will need to consider. What is the assumption about disability? This is important if you also calculate if the plan also includes disability payments. So that's one of the extensions that you can have on a plan. It can be a long-term benefit, but can also be a post-employment benefit. And also about the retirement ages. So in Belgium, currently we are or will be at 67. But they're still gradually going up to 67. You still see that very often actuaries may not use 67. They may use still 65 or in between. That's something you need to, of course, challenge. So if you look to the assumptions, that's where also you may challenge the actuary. It's very, very difficult to challenge the mathematical calculation. But really, with the assumptions, you can challenge also the actuary. It is something also that the auditor will preferably have a look at before the calculations are being made. So I would also recommend that with the actuary, before they do the calculations, ask them what assumptions are you going to use, and just cross-check with your auditor whether those are acceptable, that you don't have a surprise, because a surprise, no problem to recalculate, but unfortunately the actuary will ask additional fees for that. And you look for the assumptions, you look to the market conditions. The market conditions and the company expectations, that's for the demographic also, employee turnover, for example, and the future salary increases, which are also company expectations. You look to the date of valuation, what is currently relevant. So if we'll go a bit more deeper in the financial assumptions, the discount rate. Discount rate is, like I said, it's for time value of money. So because we will be making a payment in the future, more than 12 months, today, if I would have made a payment, the same payment, it would be less because of the time value of money. So that's why we consider also discount rates, because post-employment benefits, normally, if you have a population of young people, it may still take 30 years until you may make the first payments, for example. So you will consider that and you will show that. So meaning the net defined benefit obligation today will be significantly less than the gross defined benefit without discounting. So how do we calculate the discount rate? In IAS 19, they say you need to make references to high quality rated bonds. So high quality fixed and returns on income of on investments. Typically, it's bonds with a rating of AA or higher. So a very common reference that is being used is iBoxx, for example. But you see that the actuaries are using their own calculations, because they're doing the same calculation. They may be doing a calculation. They may select, for example, corporate bonds with those type of ratings and really calculate also what is the discount rate. A very important one is that you need to match the discount rate with the duration of your benefit payments. For example, if you expect that the majority will only happen within 20 years, for example, you will use a 20-year duration. So I think you need to make a kind of weighted average of the duration to determine which kind of discount rate you need to use. If we have an old population of older people, and it's expected within 10 years, you will use the 10-year discount rate. So that's important. What you see, how you can find it. So the actuary will propose to you. How can you challenge it? You can go to, I mentioned here a website, Mercer, and they updating their discount rates. There are two sets discount rates for IFRS, US GAAP, but also for Germany. And there you can see what discount rate we need to use. Will it be always equal? No, but I think it should be in the range. If the actuary is proposing a cross-check, it should be in the range. It cannot be significantly different. At the top, right top, you see a chart. A chart shows you with a duration of 10 years, 15 years, and 20 years. You will see how the discount rate has increased. This is not unexpected. We all know that the interest rates have increased since the beginning of the year of last year, end of last year, and you see that clearly here, that we are now almost today at a discount rate of, if you would take, for example, the 20 years, I think it's about 4.6% already. Which is good news for the liability, because the higher the discount rate, the lower the defined benefit obligation, which makes sense because we are discounting at a higher rate future payments. So the net amount, the net present value is lower than if you would use a lower discount rate. So you will see in certainly for this year in 23, that you will see that the DBO, the defined benefit obligation, will decrease. It's good for the balance sheet, of course, but of course it will be good for the liabilities. But you will see later on that the effect will go to OCI, which is equity. So on total balance sheet, it will not have a significant impact. There are also other references that you can use. If you look for iBox, you will find certainly the guidance for iBox. I know that other actuaries like Aon and Towers and Watson also disclose discount rates. Sometimes you need to register with them. Sometimes it's payable. You need to pay for it, but that's how they work. Salary increase and inflation. So depending, that's important. If they ask for salary increase, ask at least, or make sure it's clear. Is it on top of inflation, or is it really the full salary increase that you need to provide? And they will also make some proposals probably that you do, but you may have a company may have a practice of always, for example, with an indexation of always giving the employees an increase which is higher than an annual increase which is higher than the indexation. In that case, you will consider that higher salary increase into the future. So it's the expected long-term average annual rate of pay increase. So not today, but you will look to the future. What is the long-term average annual rate? Now, last year we had a significant, with the indexation, a significant index, which has the salaries have increased significantly due to high inflation, but not necessarily you consider that immediately in your calculation, because you look to the long-term average annual rate. And so in the calculation of 2022, you should have seen that normally there has not considered 11%, for example, as salary increase. And what is salary increase? It's inflation, but can be merit and promotion also, and can also be productivity gains that are being reflected in higher salary. So the higher the salary increases, the higher the DBO. It's contrary to the discount rate here. So the lower the salary increase, the lower your DBO. Why is that? Because we looked into the future, salaries will increase, so that if we count back with a higher salary at the time of expected payment, you will have a higher DBO. On the slide, on the graph that you see there, I have copied an example. It's in German from Willis and Towers Watson. But there you see, based on the duration of the plan, what it's for Europe. If you go to the purple graph, the purple line, this is the Eurozone. There you see what is the expected long-term average annual salary increase for the euro, and you see if it's short term, it's higher than, it's about 2.5%, which is still the inflation today actually. But if you look to the long term, it will equalize at 2.25 approximately. All right. In Belgium, the salary increases may not have a significant impact for the Belgian plans, but it's more the discount rate which has much more impact. Okay. Then we are at the demographic assumptions, and there the actuaries are using mortality tables. You may have seen that they refer to MR and FR, man, female rate reference. Those are references. Belgium, you will not find that in abroad, saying every country will have its own tables, I think. But those are tables made in 1992, so quite old. And currently they will apply an age correction because we are today, and today even compared to 1992, people are living longer. So they will consider that. You will see that with MR-3 or MR-5, for example. An example with this table, with the MR-3, you see that at the age of 65 here, you still use 65 as reference there. You may live 20 years longer for a man and 24 years for a woman. So the expected life is 85 for men and 89 for women. It's quite long. However, the impact is here limited. Why is it also limited? Because very often in Belgium you work with lump sum payments. So you pay at the retirement, you will pay a full amount. So the mortality, the probability of mortality after retirement age will not impact. If it's paid, for example, annually or monthly, over when they are retired, over the whole period until they die, then of course those tables may have a more significant impact. But typically, the higher the expected life, the higher also the DBO will be. Makes sense. But again, the impacts in Belgium may be limited. So how does it work? I will give you a very simple graph now, two graphs, and then we will go to more detailed calculation that I can show you how it's being calculated. First of all, that's how we look at it, and that's not actuarial. What is the accumulated benefit obligation today? So based on the service of the person, in this case, the person is 50 years old, what is the accumulated benefit obligation? And that's the actual present value of the benefits on the salaries as of and service prior to the current year. So basically all the contributions in Belgium, all the contributions that have been made by the employer and eventually also by the employee, this is the accumulated benefit obligation. So it will not consider future, that on those obligations, the future the future return on those will be already considered. Okay. If we then look to the defined benefit obligation, that's the yellow part, the total in effect. So the total of the orange and the yellow is the defined benefit obligation. So this is the accumulated benefit obligation plus the present value of the expected payments earned at the current age, based on expected future salary increases and other events. So in this example here, very simple, the person would receive a lump sum amount which is based on the salary at retirement age. So you see the black graph, the line going up to 60 years. In that case, in the simple example, the retirement age is 60. The person is expected to have a salary of 130,000 euro, approximately. So you do that. But you will today we're only he's only age 50, so you still have to go 10 years. So that's the yellow portion. We expect to pay based on the service today done at the age of 50. The person, we know that based on the assumptions that the salary will be 130,000, and we will count that back to today to the age of 50 and recognize for the service up to age 50 the additional amount, considering a salary of 140,000. Well, today he only has a salary of 90,000, which is the crossing of the orange part, orange box with the line. So that's typically what you actually will add in a defined benefit obligation, because we have an obligation of the plan to pay the benefit on the, very often that's the average salary of the last 2 years or 5 years, for example, depend on the plan that will be calculated, and based on that you will calculate the benefit. So we will have to count that back and reflect that already in the liability today, the defined benefit liability today, at the age of 50, because in that case the person already, if he started at 30 years, he already performed 20 years of service, so accumulated rights for 20 years already, and still has 10 to go. You will see that more clear in the example in Excel. So how do we calculate it? IAS 19 has prescribed a method which is called the projected unit credit actuarial method, the PUC, typically what they say, and that will use the assumption about future salary increases, assumption about other probabilities of future events like turnover, early death, disability, etc. So many different assumptions that can be included into this method. And finally, you will calculate what is the gross benefit earned today and discount that back to today with the applicable discount rate like we discussed a few slides ago. So the DBO is a portion of the present value of the total expected benefit allocated to the past based on services rendered to date. So if in my previous example, if the person would receive, for example, 1 year of salary, 130,000 at the age, he already performed 20 years and expect still 10. In that case, we will consider, okay, it's 130,000 he will receive. He already earned 20 years divided by total 30 years to work, to reflect only 20, still 10 to go, and discount that back using the discount rate to the age of 50, to today. So 10 years discounting. And that will reflect the yellow part that we have recognized. So in the incremental, recognize 20 years discounted back in addition to the accumulated benefit obligation. Okay, so what is service cost? Like Hans explained, I see a slide, a question coming. Are the slides available? Yes, they are in the handout section. In the handout section, you will find all the slides. So the service cost, it's the same thing, the actual present value, but only for 1 year, for this year. In the example here, you will calculate with 1 year here, you have the 50, between 50 and 51. That line reflects the service cost. The service cost, again, in Belgium, with the Belgian plan, will not equal the contributions you make. It will be different also because we will consider interest costs like Hans explained. But again, you will see that in the slides coming with the example. Okay. And then, okay, again, as a summary here, and then we go to the detailed example. Service cost is the current service cost for 1 year, but we may also have past service cost. Past service cost, when we amend the plan and it's retroactively, we have to calculate also the impact on the past, and we will consider that a past service cost. You may see that in the disclosures that there are past service costs included or calculated. It can be through an amendment, the change of the terms and conditions of the plan, can be in curtailment when we change significantly the number of employees in the plan, for example, because or maybe some people, a group of people are being restructured and spinned off or being sold, the business unit is being sold, can result in a curtailment. And any gain or loss on settlement of the benefits, of course, the difference between what we paid and the present value will be a gain or loss on settlement. And then the interest cost. The interest cost, and again, I will show you how you calculate it. Actually, it's not so difficult to calculate because it's based on the discount rate. You will use the financial assumption to calculate the interest cost, so it's theoretical. So you will multiply the net benefit liability. Actually, you may use the gross and then the planned assets with the discount rate at the start of the annual period. But you will also consider the contributions that are being made during the period. But again, I will show you in the example that is coming now on the next slide. All right. So here's an example. The Excel is also available. So if you want to see the formulas, it's a simplified example. It's for one person now that I show you. It's not a Belgian plan, but it's a plan that you see still. You may see it still also in Belgium. So with the Belgian plan, I mean with the minimum guarantee. So a group insurance plan, TAC 21, TAC 23. But this is really defined benefits, and that's what is the benefit here at the retirement age. The person will receive a payment which equals a certain lump sum payment, and the lump sum payment is calculated as it will be based on the salary at the last salary at retirement page, but it's calculated at 2 times a breakpoint, which is breakpoint is, for example, in this example, 70,000. So everything up to 70,000 you receive 2 times. So it will be 2 times 70,000 plus 4 times everything in excess. So your last salary in excess of the 70,000 will be multiplied by 4, and that will be your lump sum payment. But the plan requires for the full benefit to receive that you need to have 40 years of service into the plan. It may be that you entered later and that you only have 30 years. In that case, there will be a pro rata. Okay. The breakpoint, they can also call it differently into a plan. I call it now a breakpoint. This is annually adjusted for inflation. So here you see already inflation will be will be an assumption that we will have to consider. Currently, the age of the person is 44, and he already worked 8 years since the beginning of the year. So he has already 8 years of service performed at the date, at the valuation date. And his annual salary today is 88,000 euro. Okay. Then we will start. Those are facts that are coming from the plan, and the first ones are coming from the plan. The second one is coming from the demographic, from data that's being delivered by the company to the actuary. And typically, you will have to deliver all the employee details of everybody to the actuary. And then we will make some actuarial assumptions. You will have a discount rate. I have the 4.67 because I consider a duration of 20 years. And I told you in the graph, this was 4.67, the graph that I show you. I expect salary increases for 2.5%. I have an inflation rate of 25%. I didn't consider mortality tables and turnover because this is already more actually related and it's may not impact significantly. Although turnover, if you have a high turnover, it may impact quite still your defined benefit obligation. And we expect the legal requirement age is also 67, like in Belgium. So remember a bit those assumptions and those facts from the plan. So now we will do some actual calculations. How are they being done? Let's go to the calculation. You will see on the right how it's calculated, and I'll explain you from where it's coming. In the Excel, you will see the references. And on the right, on the left side, you will see really the calculations of the amount. I will show you here for 2023, but on the next slide, I will show you up to the retirement age, how everything is going, and also considering a change in financial assumption and how it will impact the OCI. First of all, we will do some gross calculations. We will calculate what is the projected salary at the expected retirement age, or PRA is the projected retirement age. Well, today I have a salary of 88,000. My salary increase is 2.5%. So I will multiply by 1 plus 2.5% to the power of, and the power is the legal retirement age minus my current age. And that's how I calculate it. If the person has 88 and the salary increases will be 2.5% each year, it will not change. The person still is on board for, or stays on board for 23 years. In that case, his salary will be 155,286. Okay. Then we need to do some calculations. Remember in the example that I gave you, the lump sum amount is based on 2 times up to the breakpoint and 4 times everything in excess of the breakpoint. In real plans, it can be totally different. So it's only an example. So we will calculate. So what is the projected breakpoint for the breakpoint? The 70,000. The 70,000. I will multiply it. I already have a higher salary, so I can consider. Even today, I already meet. I'm already in excess of the breakpoint, but I will apply also inflation to my breakpoint because the breakpoint was subject to inflation each year. So I have 70,000, the breakpoint amount, multiplied by 2.3%, 1 plus 2.3%, which is the inflation. It was a 2.25, I think. So that's rounded. And I will again to the power with 23 years because it will be, I will only determine the breakpoint at the retirement age to do the full calculation. That's typically how it works with a defined benefit plan. So the projected payments from the breakpoint is 116,000 or 170,000 euro. And then the difference in excess of the breakpoint is the difference between the 155, 116, which is 38,000. And I expect still 31 years. I will have 31 years of service in my example. So 8 plus 67 retirement age minus I'm today 44. Okay, so let's start now with some calculations. What has the person already earned? Earned is I already performed 8 years of service in that case. So I will calculate the formula, only consider the A as per benefit formula. I have 2 times the breakpoint, because the breakpoint calculated at the retirement age will be 116. So it's 2 times 116,776 plus 4 times in excess of 116,000, the 38. It's not mentioned. It's in the line with the hashtag. Apologies for that. Multiplied by 8, because I'm already 8 years further. It's also not good. It's multiplied by 8 divided by 40. And that, sorry, I will show the Excel maybe to do. I have it open. No, I haven't opened it. Okay, so it's 8 divided by 40, because I need to have 40 years of service in order to have the full benefit payment. Okay, so my benefit formula today, based on the 8 years of service, if I would stay still, because that's a requirement, but today for the 8 years, I have earned already 77,000 euro gross. This is not discounted, because the payment will only happen at the retirement age. Then I will calculate the discount factor, financial discount factor. So it's 4.67 today. This is an assumption made. I will have to pay it only at retirement age. So the formula is 1 divided by 0.467 to the power of 23, and that will give you the financial discount factor. It's just a factor that we use to discount. You could use that formula even immediately on the amount also. So if you then calculate, if I would use the 77 here, that's the gross. I need to discount it. I will multiply it by the 0.35, and that will give me, at the beginning of the year, I already have a defined benefit obligation of 27,133. Okay. Then I will calculate what is the current service cost, the benefit attributed this year. This is gross now. What is gross? So I will calculate again. I have my formula. If I stay, it's 2 times 116 plus 4 times the amount in excess, multiplied by 1 year, divided by 40. 1 divided by 40, I will give you the 9,690. So if I work 1 year, I earn gross 9,690 euro because I stay 1 year. But it will only be paid at the retirement age, so I need to discount it, and that's then the current service cost that you see in the tables from the actuary, 3,392. So the 9,690 multiplied by the financial discount factor. And then we have the interest cost. It's a simplified example because very often you will see we didn't consider past service costs, we didn't consider administration costs, etc. You will see that in the example of Agfa Hevart that I will show you afterwards. What is the interest cost? Because we don't have assets here, but we calculated for the DBO. So I have my amount at the beginning of the year. I will add my current service cost. I will multiply it by the discount rate. And that's my interest cost. So simple. The total of the 27 plus, so total of 4 plus 6 plus 7 will give me the 8, the expected defined benefit net at the end of the year. There's no asset, so this will be recognized as a liability, 31,950. So that's how you see how the logic works of an actuary. If you now project that table to the retirement of 67, there you see the first column with 8 is the column that I just have explained to you, how it's being calculated. And then you see it is moving. So the end balance at the end of the year is the beginning balance for the next year, and you start calculating. What you see, of course, is that your current service cost is increasing. Of course, logic, because we need to discount less. If the discount rate is the same, there's less discounting impact, so it will increase. Typically, you see that if you go to the last column, list of 67, you see that the current service cost of 9,690, that's the gross amount, not discounted, because it's less than 12 months. Okay. All right, the interest cost, same calculated, it's also increasing just because the defined benefits, what you have earned, is also increasing in gross amount. So the impact of the discounting is much larger. At the end of 67, the last year, this is 12,403 euro. Typically, just to show you how it works also, you see the green cells. Today, I showed you the calculation. The projected salary was 155. The projected breakpoint was 116. You see that also at the age of 67 with all the assumptions that the salary is indeed 155 and 116. So it's a cross-check into the calculation. The orange parts, there I show you the impact of changes in assumptions. And I'll only change the financial assumption discount rate, where you see that I increased it in between the year, his age of 45 and 46. I changed the discount rate to 5%. Higher discount rate, lower DBO. So how it's calculated, you see then what it will be at the bottom in the calculation from the net defined benefit beginning of the year, end of the year. You will see that you will have an OCI impact. You will see that also in the reports, OCI, financial assumptions. I increase my discount rate, it will have an impact. It has an impact also on the past. It has an impact on the interest costs that I have recognized. No, not on the interest costs. It has an impact on the past. On the 37, what I already earned the year before is now discounted also at 5%, and previously it was 4.67. So it will be less. So it's negative. So the financial assumption and OCI will recognize 2,377 in credit. It's a gain actually from an OCI point of view. Okay. You see the reverse in the year when he comes the age of 48. I decrease it back to 4% from 5 to 4, and there you see the reverse because the discounting is less. My DBO obligation present value will be higher. And that has an impact on what I already recognized previously. So at a discount rate of 5%, and that has a positive impact on OCI, meaning I will debit OCI and credit my liability in that case of 9,175. Remember to recognize also deferred taxes on that. So what you recognize also in OCI will need to be reflected net of deferred taxes. Okay.
Important there as well to consider is that this is only the DBO calculation. Obviously, you will have an effect on your fair value of your plan assets, which is typically, if you look at the discount rate, the other way around. As I said, because of the difference in interpretation, typically the discount rate will be slightly corrected for the plan assets compared to the DBO, but that will largely offset the impact that also goes to OCI. So you have the defined benefit obligation, as Sam is explaining, but you also have the fair value of the plan asset, which is also influenced by, for example, the discount rate.
Okay. Yeah. Thank you, Hans. Also important, you have experience adjustments, but I will show you that later. But that's our difference between actual rates and assumptions, like Hans already explained in the definition previously. Okay. So the net, you will always present net, like Hans already explained, with considering also the asset ceiling, what you have, but you will explain the net defined benefit is a DBO minus the plan assets that you have, which also have been discounted. Okay, so defined benefit cost, it will consist of a service cost, like explained, a current service cost. It will have interest on service cost, past service cost. It will have a net interest cost, net because you will net the interest cost from the DBO and the plan assets. Yeah, in the tables you may show it gross, in the net table you will show it net. That will go to P&L. Service costs will also go to P&L, and the remeasurement, changes in assumptions, demographic and financial assumptions, but also changes between the actual return, for example, on assets, and the theoretical return, the assumption that you have made. Those all go to OCI as a remeasurement. Typically, you will mention OCI from financial changes in financial assumptions, OCI from changes in demographic assumptions, and OCI from changes in experience adjustments that we have done. And also, like Hans explained, the OCI is not recyclable, so it will never end up in P&L. To be considered also when you sell a business unit with actual gains and losses in equity, because you cannot calculate the gain or loss on the disposal considering also this OCI, because it may never end into your P&L. Okay, we still have 10 minutes to go, and let's go to
two points to consider there. For those employers working with an externalized pension fund in Belgium, the pension fund itself also has actuarial calculations. Whereas a lot of actuarial assumptions will be similar, they will not necessarily be exactly the same as required by IAS 19, because for pension funds, some actuarial requirements are driven by the requirements set by the FSMA, who has sometimes a different legal point of view than what is asked by IAS 19. So if you have a pension fund, note that calculations required by IAS 19 might not have the similar assumptions as is the case for the pension fund from a legal point of view. And I think second point, I think the example here is still simplified. The reality shows that there are a lot of more other things to consider. A typical example in Belgium is death in service benefit. If people die before they retire, they get a lump sum payment. And then the key question will be, we're not going to do in detail, but the key question will be, is that insured or is that risk taken up itself? If it's insured, then obviously there is no risk on your defined benefit obligation of a change in what actually has to be paid. But then part of the contributions paid by the employer will typically be used for your insurance premium. So you will have less income in your plan assets. If on the other side, there is no insurance taken up for that, then you will have to include that as well in your DBO calculation of what is the chance that somebody would die earlier and would be entitled, or at least would be entitled to a lump sum payment as foreseen in the plan. So that's a typical example in Belgium that complicates even further the calculation, which is not included in our example here.
Yeah, okay. Let's go to the example. Let me see where it is. There it is. Yeah. Okay. So I took Ach van Hevaart, just a random one, but and also they have some post-employment benefit plans in Belgium and also abroad. So there you see it will be you will have to include qualitative disclosures, qualitative disclosures about the plan and the terms and conditions, and quite a lot of quantitative disclosures. The quantitative disclosures normally should be delivered by the actuary, so you need to ask for a report including the IAS 19 disclosures, and that will help you to complete all the to meet all the disclosure requirements in your IFRS financial report. So you see here with post-employment benefits, you see here first the net. What I show here, just in general, some text, all the details are coming later on, but that's a general table that reconciles with the balance sheet, where you show the net liabilities and then also the net assets, and you will net it, and that will, so the balance sheet position in 2023 will be 503, I think it's even million euro in that case here. Yeah, that's million euro. For Belgium, and then in total 513. So if you scroll further, they will show the expenses. So that's one of the requirements also, is that you explain also the expenses. This table in itself is required. You can do it also per plan, you can combine it. but there you see is that they combine it by country, and there you see what is the current service cost, the line 2, what is the past service cost, what are some settlements that we have done, the gain and losses on that, and there you see also the return guaranteed by the Belgian law that they put separately. I have not seen that necessarily separately into to some of the disclosures, and that equals the 37,000 or 44,000 in 2022, which a million, which is the expense that they have shown into the P&L of their financial statements. You also see the net interest and then the total expenses. Net interest actually is also, you see some different ways of showing that. Some people still show that above the line, above operating. Some include that in financial because it's interest, it's discounting impact. They include some general things. That was general, and then they go to each of the plan. Defined contribution plan. The requirement is there only if it's defined contribution. What are the payments you have done, or what is the expense of the defined contribution pension funds in your P&L? That's the requirement you need to make. They also say for Belgium that the IFRS is considered a defined benefit plan. Although legally it's a defined contribution, in IFRS it's a defined benefit. And then they start explaining, and that's the qualitative disclosures, what you also have seen today on the slides that Hans already has presented. But let's go, that's all qualitatively, it's quite extensive here. I know also that Agfa Hevaert has, beyond the Belgian plan, the group insurance have also more real defined benefit plans from the past that they need to consider. Voilà, let's go through it, quite some explanation. You need to do all the terms and conditions of each of the plans. And then you will start here showing the evolution of the net defined benefit liability. You need to show. You see what is included in cost, the 44, for example, in 2022, the first line. This is reconciles with the first table that we have shown. What are the remeasurements of changes in financial and assumptions in OCI? It's 145 negative, so it's a benefit. It is a gain from an OCI point of view. There may be some transfers, and then the cash flows are the employer contributions. We already paid benefits to persons who reached the retirement age, and there's some currency effects, of course, because they work with foreign entities also.
Important here to see is as well, and sometimes it's strange to consider that the employer contributions have the negative effect, and there's logic because the employer has paid amounts into the fund. It is actually reducing the net liability to be presented.
Yeah.
So it's increasing the assets, so it has a positive effect on the net liability to be shown.
Correct. Then again, the defined benefit costs, the same table that we see in the beginning, but they have split it a bit more in detail. Certainly with the net interest cost that's being split between what is part of the liability and what is part of the plan assets, but we will only show the net interest cost. And you will also show what is the impact on OCI. And there you see the experience losses on plan assets, the 31 in 2022. So, and at the bottom of the table, I think the sixth line from the bottom, experience losses gains. That are lines that difference between the actual, for example, the actual return on the plan assets and the return on plan assets excluded interest income. That's the last line before the green part, but the experience losses are on the liabilities. So changes, for example, in salary increases compared to what we have assumed with the assumption. Those are all recognized in OCI. Demographic assumptions, changes in turnover, for example, changes in mortality tables, etc. And financial assumptions can be changes in, very often here, can be changes in 2023. So pretty sure this will be two-part. This will be based on the condition, on the discount rate, and to a lesser part, maybe the expected salary increases because of higher inflation.
And you indeed see here that the financial assumptions and the return on plus assets are partially offsetting, and that they were much higher in 2022 than in 2021, which explains discount rate that went already up from 21 to 22, and most likely in 23 it will be even further increasing because discount rates have gone up. Obviously, in the financial assumptions, there are more to consider than only the discount rate, as some explained.
Okay. So again, we go further. Yeah, the changes here. Again, they have a lot of tables, and I must say that they duplicate a bit, or seem to duplicate a bit. You may be doing, but here they split it for Belgium, for example. What is the impact in Belgium for the real DC with the DC plan and the DC plans? DC plans with the guaranteed return and the real defined benefit plans. The same thing where you do the roll forward, like the things we have been explaining already before. But also for the plan assets, and there you see, like Hans explaining, you see also the employer contributions, which are then a plus. I'm paying, it reduces my net liability. It will not reduce my gross liability, but it will increase my plan assets. So in that case, my net defined benefit liability, gross minus assets, will obligation minus asset will of course be a deduction of your net defined benefit liability. Okay, benefit payments are of course also and less. So it's your plan assets will decrease, but also your obligation will decrease. You see the benefit payments are the same in the obligation compared to those in the plan. Typically, this should be the same normally. All right. Then you see, you need to mention all the assumptions. Say they have inflation and discount rate, or you only need to explain the assumption who have a significant impact on the calculation. So not everything. So here they did it. They show it on the weighted average because they combine it over the plans. You also need to mention the weighted average duration. So what is the average duration that the people will still be in the plan until the retirement age, until the defined benefits will have to be paid. Sometimes they mention duration is what already has earned. So the difference is not until retirement age, but they're already 20 years of service. I think the standard really requires durations up to the time of retirement normally, which also makes sense from a disclosure, more sense from a disclosure point of view. To give you an idea, in that case here it's 10 years. So it means that on weighted average, the benefits will have to be paid within 10 years, which is quite short. You will have to do a sensitivity analysis on the significant assumptions. So what if the discount rate would increase by 50 points or decrease by 50 points? You see, of course, an increase in discount rate will reduce the liability, and decrease of discount rate will increase liability. Inflation, just reverse. Higher inflation, higher salary increases, higher DBO. In the reverse, it will be lower DBO. And changes in mortality tables has an impact here. You see, it's 35 or less than minus 33. 1 year longer, 1 year shorter. I don't see that very often. It must be because you see 35 million. The mortality tables still has quite an impact here. If it has an impact, you need to mention the sensitivity. Then also on the plan assets, you need to make the split. And we are almost there. I know it's 12:30, but you need to make a split. What kind of investments do you have in the plan assets? Typically for the Belgian plan group insurance, you may mention it's a TAC 21 investment, for example, through an insurance company, but not always it's like that. And you may mention here then what is cash, what is equity, shares, what is debt instruments, bonds, what are investment funds, for example, etc. So you need to mention that. You see that the Belgian plans, you see assets held by insurance company, those are for the Belgium DC plans, but also the in UK, what I see. And then also last, what you need to do is the expected defined benefit cost for 2023. So what do you expect for contributions to be made for the next year that you need to mention also into the plan. Normally, again, the actuary will give you all those disclosures. Okay, and then you have still some explanations for long-term benefit determination benefits, but very it's not so material. That's why they don't explain a lot. Voila, I think we are at the end of the webinar. I don't know if there are still questions. No, I don't see questions for the moment. If there are any questions later on, don't hesitate to contact us. You have our email. You see here where you can, the general office in the slides, and yeah, happy to answer any question or to help you if necessary. I thank you very much for attending, and see you on the next webinar, I think the 16th of November. Thank you. Bye-bye.